Just enjoy and listen to, and have a fun of it.
Starty, just have fun. Story radio station tater tart. Welcome to the deep dive. I'm Dexter, really excited to guide you through some pretty complex market stuff today.
And I'm Claire. I'm here to help connect those dots, figure out what the big global players are, well, really up to behind the curtain. We're diving into something that touches almost everything: electric cars, buildings, the whole strategic game being played with non-ferrous metals.
Yeah, it's fascinating stuff. But hey, before we really get into it, just a quick reminder, please hit subscribe, like this deep dive if you find it useful, and maybe turn on those notifications.
Good call. We wouldn't want you to miss the next one.
Definitely not.
So what was it about this topic that really grabbed you? Why this one?
You know, I picked this because, honestly, I was just genuinely shocked when I first understood it. The idea that the prices manufacturers pay aren't just about simple supply and demand, like how much is mined or how much factories need.
Right. It feels like it should be straightforward.
Exactly. But instead, you have these huge trading firms, and they're deliberately kind of artificially tweaking supply and demand, all to boost their own profits. It sounds like, I don't know, a movie plot.
But it's real. It's like this hidden hand in the whole supply chain, and it's incredibly powerful. So our mission today, let's set judgment aside, okay? Let's just focus on the mechanics. We need to understand how they actually pull off this market control. It's often called the warehouse play.
Warehouse play, right.
And it all hinges on the structure, the framework of the London Metal Exchange.
Okay, let's start right there, the foundation. For those of us, not trading commodities daily, what exactly is the LME, the London Metal Exchange? Why is it so important?
Think of the LME as the central hub, the nerve center for non-ferrous metals globally. It's the exchange that sets the key benchmark prices for the big six: aluminum, copper, nickel, zinc, lead, and tin. It's really the critical point where, like, financial contracts meet the actual physical metal.
Gotcha. The benchmark prices. And that link, the connection between the finance side and the physical bars or ingots.
Yeah.
That's the LME warrant, isn't it? The piece of paper that says, this metal is mine.
That's exactly it. A warrant is just a transferable certificate. Simple as that. It proves you own a specific lot of metal sitting safe in an LME-approved warehouse. Theoretically, it should tie the futures price directly to the physical stuff.
Theoretically. But that's where this warehouse play comes in, right? Where that link starts to get a bit stretched. Can you define that play a bit more clearly for us?
Sure. So the warehouse play isn't just one single thing. It's more like an umbrella term for a set of really sophisticated strategies. These big metal owners, the trading houses, they use the LME's own rules, especially around storage rent and the futures price spreads. They exploit those rules to, well, manipulate how tight the market feels and optimize their profits, of course.
Right, exploiting the rules.
Yeah.
So the engine driving their profit machine relies on two key market conditions, these price dynamics. We need to understand contango and backwardation.
Absolutely crucial. Let's start with contango. That's usually seen as the normal state. It just means the futures price, the price for delivery later, is higher than the spot price, the price right now.
Okay, normal state. Futures price higher.
And this allows for what's called the positive carry strategy, or a carry trade.
Positive carry. So how do they make money from contango? What's the actual trade?
Well, assuming they manage their costs right, it's almost like a guaranteed return. They buy the physical metal now, the cheap stuff. They stick it in an LME warehouse. And at the same time, they sell a futures contract for delivery later, locking in that higher price. Now, here's the kicker. Warehouse operators often give them discounts, maybe incentives, to store metal there. So the storage itself can become profitable, which guarantees that positive carry.
Ah, okay. So they literally get paid to hold onto the metal while waiting for the futures contract to mature. Makes sense.
Exactly.
But let's flip that. What about the opposite scenario, the more intense one, backwardation?
Right. Backwardation is the mirror image. The price for getting metal right now is higher than the price for delivery months down the line. This screams, urgent, short-term physical supply problems, real tightness.
And this is the setup for the riskier, but potentially way more profitable squeeze strategy.
Precisely. The squeeze. This is where controlling the available metal, both the official LME stock and the hidden stuff, becomes a weapon. By limiting the supply that people can get their hands on quickly, these traders can put immense pressure on anyone who bet against the price, rising the short sellers.
Forcing them to buy back at painfully high prices to cover their positions. Ouch.
Yeah. And really, nothing showed the LME system's vulnerability to this kind of play quite like the whole loadout queue controversy.
Yes, the infamous queues, that delay. So the loadout queue is just the waiting list to actually get your metal out of the warehouse, even if you own the warrant. Why does a simple delay have such a big economic impact?
Because, and this is key, that delay creates what's called a structural discount for LME warrants. See, the official LME price is based on the lowest value warrant.
Lowest value, meaning the one stuck in the longest queue.
Exactly. So if the LME price is reflecting that cheap stuck warrant, you might ask, why doesn't someone just buy that cheap warrant, wait in line, get the metal, and sell it physically for a higher price?
That sounds like basic arbitrage. It should balance things out.
It should. But the waiting time, the uncertainty of how long you'll actually wait in that queue, it kills the guaranteed profit you need for arbitrage to work smoothly. It makes owning that cheapest warrant too risky. So it trades at a discount compared to metal you can get right away, what they call free metal.
And that discount keeps the physical premium high. The extra amount users actually pay on top of the LME price.
Bingo. The gap between the discounted LME price and the real-world physical price stays wide. And that gap, that's pure profit potential for the traders managing the queues and the metal flow.
And we saw this play out dramatically, didn't we? Those queues in Detroit, for example, caused the U.S. Midwest aluminum premium, normally like, what, 3 to 5 cents a pound, to just explode.
Explode is the right word. It hit $1.22 per pound.
Good evening, and welcome to the Story Radio Station, where we explore tales from around the world.
Things like contango, backwardation, and especially those loadout queues basically created loopholes. Big profit opportunities.
Right. The structural flaws were the foundation. Now, let's talk about how the game evolved, specifically how traders started exploiting transparency, or rather, the lack of it. Hiding the inventory became key.
Okay. This brings us to off-warrant stock. This is the metal that's physically in the LME warehouses, but it's sort of invisible. The market doesn't officially see it on the books. How did this huge hidden stash come about?
It's actually a fascinating story of unintended consequences, regulatory blowback, really. Back around 2014, the LME was under huge pressure to fix those crazy long queues.
Yeah, they were causing chaos.
So they introduced a reform. Its official name was queue-based rent capping, QBRC for short.
QBRC. Okay. Sounds technical. What was it supposed to do, and why didn't it work as planned?
Well, the idea was to discourage long queues by hitting the warehouse's wallets. It basically said, once someone asks for their metal, you can only charge rent for a limited time, capped at 80 days, even if the queue is longer.
Okay. Trying to remove the incentive for long queues. Makes sense.
But the big traders, they're always thinking ahead. They just found a workaround. Instead of requesting delivery and getting hit by the queue and potential rent caps, they simply started canceling their warrants.
Canceling them. So taking the metal off the official LME register.
Exactly. They moved the metal off warrant. It was still physically sitting in the same LME-approved warehouse, but now it wasn't officially part of the LME system. This meant they could often get cheap, sometimes even free long-term storage, completely bypassing the QBRC rent cap and disappearing from market view.
Wow. So a rule designed to fix the queue problem and maybe increase transparency actually ended up creating this massive hidden pool of inventory. Less transparency.
Precisely. And that lack of visibility, knowing there's this huge unknown amount of metal lurking just off stage, it allows players to influence prices with much smaller visible LME stock positions than before. It amplified their power.
The regulators must be trying to catch up, though.
They are. It's a constant battle. The LME started making warehouses report off-warrant stocks monthly back in 2020, but the big move, a really significant one, started April 1st, 2025.
What happened then?
They mandated daily reporting. T+1, meaning the next day. Daily reporting of off-warrant stock. That's a huge step towards trying to shed light on these hidden inventories.
Daily reporting. That sounds like a big deal for transparency, but is it the end of the game or just the next move?
Likely the next move in the cat and mouse game. If LME-approved warehouses become too transparent, what's the logical step for a trader wanting to keep inventory hidden?
Move it somewhere else.
Yeah.
Somewhere not LME approved.
Exactly. Move it to LME non-registered warehouses. Basically, off-exchange storage. Keep it out of the regulatory spotlight altogether.
So the cycle continues. Regulation tries to close a loophole. The traders find a new way around it.
It really underscores that the warehouse play, at its core, is about exploiting these structural and regulatory gray areas. always seeking that gap between the LME paper price and the actual physical cost.
Okay, so who are the main players mastering this game? And are we talking serious money here?
Oh, serious money is an understatement. The key players are usually the huge integrated global trading houses. Think Glencore, Trafigura, Mercuria, companies with massive logistics networks and deep financial pockets. They leverage these structural gaps globally.
Yeah.
And the profits, get this, Glencore's earnings from just metal trading, their EBIT, earnings before interest and tax hit $1.57 billion.
Whoa, wait. 1.57 billion? In how long?
In just the first half of 2025, 6 months.
That is staggering. Just the profit from trading metal for 6 months is more than the entire GDP of some countries. That's immense financial power concentrated right there.
It really is. And the game continues. We saw just this year, Mercuria, for instance, reportedly under scrutiny for their positions in the aluminum market, especially with backwardation risks still bubbling up. It's ongoing.
Which brings us nicely to the current market picture. Because 2025 has definitely felt like a stress test, hasn't it? Let's look at copper first.
Absolutely. Copper's been a major focus. Prices hit a record, didn't they?
Yeah, $11,200 per ton back in October 2025, a record high.
And the underlying reason is inventory stress. Official LME registered copper stocks are still described as critically low. We're talking around 134,000 tons globally.
Which sounds like a lot, but in global terms.
It's not much buffer. And critically, look at the off-warrant copper, the hidden stuff. Estimates put it around 30,000 tons, maybe a bit more. That's less than a quarter of the registered stock. It offers very little cushion if there's a sudden real-world demand spike or supply disruption.
Not much backup. Okay, what about aluminum? That seems more driven by politics and regulations lately.
Very much so. You've got the ongoing impact of sanctions on Russian metal, creating uncertainty. And then there's the huge question mark hanging over the EU's CBAM.
Right, the Carbon Border Adjustment Mechanism. That starts January 2026, right? Taxing imports based on their carbon footprint.
Exactly. Big implications for aluminum production globally. All this uncertainty and pressure has pushed up the physical premiums again. The key Rotterdam P1020 premium recently jumped from maybe $150, $170 per ton to around $185, $200 per ton.
Another sign of that disconnect between LME and physical reality.
And you see these big inventory movements like 156,000 tons shuffled around Court Clang recently. That's likely not a simple supply shift. It's probably sophisticated inventory management traders optimizing those rent deals and warehouse incentives we talked about earlier. Strategic rotation.
Okay, let's boil this down. For someone listening, maybe they work in procurement, maybe they run a manufacturing business that uses these metals. What's the big takeaway? What do they absolutely need to understand from all this?
The single most important thing is you absolutely cannot rely only on the LME futures price to hedge your real-world costs. Full stop.
Because the LME price is skewed.
It's fundamentally skewed towards that lowest value warrant, the one stuck in the queue, the discounted one. It simply doesn't reflect the actual price you have to pay to get physical metal delivered to your door when you need it.
So that's the actionable insight.
Yeah.
Don't just hedge the LME price. You have to manage the risk of the physical premium, that Rotterdam premium, or the U.S. Midwest premium. You have to manage that separately.
Yes. And now, with the new daily off-warrant stock data that started in April 2025, you actually have a better tool. It's not perfect, but that increased transparency is your best bet right now for trying to anticipate where regional physical markets might get tight.
Use the data. Build resilience.
Exactly. Understand the flaws, use the tools you have to navigate them.
Okay, that's a powerful takeaway. The system has issues, but there are ways to be smarter about it.
So wrapping it up, the warehouse play persists because it's rooted in these fundamental structural issues within the LME system, that gap between the paper contract and the reality of getting physical metal quickly. And those huge profits we mentioned, they're the clearest proof that the headline LME price often doesn't represent the true cost of metal in the physical world.
Okay, here's a final thought I want to leave you with, something to really chew on. When you see reports of low LME inventory levels, don't just automatically think, oh, demand must be super strong. That's the standard bullish signal, right?
Right. Low stock usually means high demand.
But maybe we should see it as a distorted bullish signal. Distorted because, yes, demand plays a part, but that low visible LME stock is also heavily influenced by players strategically pulling metal off warrant.
Yeah.
They do it to capture that high physical premium, not just because factories are buying everything in sight.
That's a great point. The low inventory itself is partly a symptom of the game being played. And that cycle you mentioned, regulation, evasion, new regulation, it's likely to continue, which means volatility, especially in those physical premiums, is probably here to stay.
Fascinating and, yeah, maybe slightly disturbing game indeed. Well, that's all the time we have for this deep dive. Thank you so much for joining us.
We really hope this breakdown was useful and maybe shed some light on a complex market.
We'll catch you on the next one.
With you.
A no-show